Today I want to do a masterclass on market structure, price patterns, and the market rhythm with you. And I have prepared a lot of interesting charts. We're going to go through them step by step. Every time we're going to learn a new concept and I will show you how to put everything together. So we're starting here with a recent example of gold, and we are on the 1 hour chart, and I want to dissect the chart here step by step. And one of the first things that I always look for in a market that I'm analyzing is trending stage, and also do we have a pattern. And when we clearly look at this market, that we can see we have rolled over and we are in a clear bullish trend right now. And what we also see is that the bullish trend started here with a triple tap. I made a lot of videos about the triple tap because I think it's a very important pattern, and very often you will see that this is a reversal pattern. So after the triple tap, the market clearly rolled over, and then what we want to do is count waves, and we want to see in which trend stage is the market currently in, because that tells us a lot about, are we looking for trend following or are we more looking for trend reversal trades. So after the triple tap here, this is our first trending wave. We broke the previous highs for the first time, trend wave 1. Then here is our consolidation wave, trend wave 2. Then we have our continuation wave because we break the last highs, trend wave 3. Then here we have a sideways flag consolidation, 4. And then we have our last leg for now, trend wave 5. And the last trending wave is not always, but very often it's the longest trend wave. And this is often, not always, the final leg of a trending market. At the wave 1, very few people are aware of it. Probably the reason why the market is shooting up is also because a lot of sellers who previously sold the market are getting out of it. And if sellers exit their position, that's also a buying pressure, or that adds to the buying pressure. But at the middle stage of a trend, wave 2, 3, 4, that's slowly where the majority is starting to notice the ongoing trend. And that's why very often is then the breakout out of wave 4 into wave 5, it's the biggest push. And when you can see that you have wave 5 and it's also a very long trending wave, that can tell you that you are in wave 5. And at that point, I would shift my mindset a lot. And from that point on, I would not look for continuations that the market is going to go higher, but I would look for exhaustions that the market and the previous trend, in this case the uptrend, is losing steam, and we may be even able to get into a reversal trade. And reversals are really interesting because just like here, when we rolled over from the triple tap into the new trend, if we are able to catch reversal trades, we are often able to get into new trends very early on, which means we can get in with a good reward to risk ratio. Very often we can get in with tight stop loss orders as well, and that's a good way to trade. So that's why I would really recommend you specialize in those late trending phases. First of all, start to observe what does a good late trend stage look like, what are the criteria, just like what I just explained with the big trend push, the trend continuation in wave 5, and so on. But there's much more. What we can also do here is look at the pattern, and we can see that the market put in the high here, 1730, and the market afterwards for now was not able to get close to it or even break higher, right? So each time the market had a push higher, there was less and less bullish strength, especially here where we are currently, 1750. And you can see it's quite a big distance between this high and where we are right now. So that tells us also that we are losing strength, and especially in the context what we have seen here, that is a very important finding. What I would also recommend, let's first get rid of this, is that we consult market structures. So we zoom out a little bit, and what we can do is turn on supply and demand zones. If you are interested in this automatic supply and demand indicator, check the link in the video description. It's an indicator that we made on Pattern Alpha. And what we can see here is that here's a very, very classic area, and the market moved into this and showed a very strong reaction. And the reason why I say it's strong is because this area for now kept this long uptrend from pushing higher. So there was clearly a lot of interest in this area, a lot of selling interest, also probably a lot of people who bought the market up here were looking at this zone and use it as their take profit. And if you have a lot of buyers who take profit on their trade, that also means that it gets harder to push above this area, because if buyers exit the market, there's less buying pressure. So that is why the market has struggles here to break above that. So what I would recommend, and that's I think a very, very important lesson in general, if you are a pattern trader, if you are a price action trader, maybe you focus and specialize on triple taps, maybe divergences, maybe just candlestick patterns, I would always recommend don't trade them everywhere, but only trade them where they make sense. Look at supply and demand areas, look at important support and resistance levels, and if you can have that as a filter so that you don't trade your patterns all over the place, but only at a location where you have an additional, we call it confluence factor, so another important piece of information, another signal, another criteria, however you want to call it, that can often really improve your chances for finding successful trades. So in that case, we have a supply and demand area, and that's also very, very important to note about this. What this does is that it makes this pattern now even more likely to be a reversal pattern, because as long as the market is staying below this area here, there is a much, much higher chance that we're going to roll over. Of course, if the market breaks above this, then I would completely change the picture, but from now, everything that we've gathered, it looks like we should get ready for a buying or for a selling pressure come. One other thing that I would like to do is look at market expectations, and I want to see, has the market exhausted its weekly target? And for that, we turn on exhaustion zones. This is also an indicator that we developed, and exhaustion zones give you this box. For every week you have this yellow box here, and what this shows you is that when the yellow box starts, that's what the projected average target for the given market is for that week. So it means, so the market started here, this is the open of the new week, and at the open of the new week you get this box here. And it means that if the market reaches this area, historically, based on what has happened in the past, the last few weeks and months, this is where the market has stopped trending. So we look at, okay, how many pips and points did the market trade last week, the week before, the week that before, and then we average that, and that is the box. And as traders, it's very important that we know how much did the market that we want to trade move last week. Because here what we can see, last week the market moved into its exhaustion zone at the end of the week, and then the trend was over. So that's very, very important to note. You can use that as your target as well. Here this week we can see we moved into the box very early on, not even halfway through the week. And that shows you that there was, obviously we can see that there was a big trending push, but knowing that this trending push is already what the market is usually doing in a given week is very important, because at that point it is very unrealistic to believe that the market is going to make a huge push. Obviously the market can push into the zones, and sometimes you can see we get all the way through the halfway point in the zone, but those are rare circumstances, and that's how this indicator is set up. The box, as soon as we move into the box, it shows you at this point it's not likely that the market is going to make an additional push further. And everything that we know at this point, we have the zone, we have the stage 5 trend, we have now here also the exhaustion. If you are bullish and if you are in a long trade, you should really start thinking about taking profits, especially afterwards when you see you're making lower highs and you're not able to push higher into a new high, which the market previously always was able to do. We had a high, we made a dip, and we pushed through it. Made a high, lower, pushed through it. Now the market made a high, pushed lower, is not able to get above this. This is now so many signs pointing towards the market not showing a lot of bullish strength that it is time to rethink your position. And what we also can do is look at the pivot point structure. I love pivot points, as you probably know if you've been following my YouTube. And what we can see now is a change in pivot point structure. So remember, we talked about the triple tap. Prior to the triple tap, the pivot points were moving lower. Here on the triple tap, we see the change. Now the pivot points are roughly equal, slightly higher, and that shows a trend change. And then the pivot points only move higher and higher and higher until here, where we see another change. And this is not always, sometimes we will just go over into a range, but at least what it shows you is that what has happened previously is clearly changing. So the uptrend is now clearly over, and there's a high likelihood that either we go sideways or reverse lower. And then we can start making trading plans. And this is how I would really recommend that you start applying or looking at charts. You really start with one thing, one idea, one concept, and then you look for other confluence factors that confirm your trade idea. However, to avoid the confirmation bias, I would also recommend to look for things and signs that go against your trade direction. So we don't want to be locked in only into a short position. We want to also know what would us cause to turn more bullish. And clearly, if we get above this area, which is here our supply zone, it's also the high and lows here. If we get above this, I would clearly turn very bullish again. But if we get below this area, this is a market that screams short. And that is how you could develop a trading plan. And a big problem that I see with many amateur traders is they approach their trading very one-dimensional. They only look for a pattern. And once they see a pattern, they jump on it. And obviously that's not good enough. That's not robust enough. You will find patterns many, many times all over the place, all the time. But they often don't work out. And the reason why they often don't work out is because you don't have enough information. You want to see what happens around it. Does the area, does the price action, does the timing, where the pattern is occurring, does it make sense? And does everything fit together? And once you can apply and approach your trading from this perspective, where you look at multi-dimensional signals and look at the whole chart context and look at all the different pieces of the puzzle, trend stage and so on and so forth, that's when you will start looking at charts very, very differently. And then you can distinguish, is this a good chart? Is this a bad chart? And what is missing here? And then we can see, let's follow the price action. We have a lower bounce, break and retest, and then we roll over. Very clear charting structure, very clear market that we are looking at right now. And you can see everything started here from this pattern. We have the break and retest. You can see we have here our pivot structure. We have here a little bit of a pivot cluster. So the pivot points are moving sideways because we are in a range. You can see we have this flag breakout, very complex flag. And that is what we have been looking at here with gold. And you can see very, very interesting chart example. And a lot of traders will often say, I'm cherry picking my charts. And that's absolutely the point of trading. You want to make sure that you only trade always the best charts that you can find. And in your trading, when you look at your trading journal, you want to make sure that all of your charts look really great. They look perfect. You don't want to get into charts that look so and so. So your charts should always look like you handpicked them, because you do. You want to make sure that you find all of the criteria, as many things and signals as you can, and really have as many things on your side as you can. Now I want to talk about one of the most fascinating topics that I've ever discovered, and we can call it market rhythm or whatever you want to call it. But generally what we are going to examine is the relationship between trending, impulsive. Why does the market move in this specific rhythm? Why is this trend wave this long? Why is the consolidation that long? Why is the next trend wave going to here, not to here, not only a little bit? Why are we having this area? Why are we moving over here from a long trend to a short-term downtrend? And there's a reason for all of that. And there's a very specific market rhythm. And for that, we're going to use the Fibonacci tool. So in trading view, this is called Fibonacci retracement. And what we want to do is we always want to look for this A, B, C pattern. And there's a fascinating rhythm behind it. And what we will often see is that if we are able to find this ABC move, so A, B, C, we can pretty much predict with a very high certainty where this point D is. And that is so helpful because it will tell us when to get into trades, when to get out of trades, when do trends reverse, when they continue. So let's look at the market here. We can see we have a push and a counter push, push, counter push, push. So let's examine each of those waves. We take the Fibonacci tool, we drag it from here to here. What we can then see and what we're looking for are the retracements. You can see 61. And without a lot of math, what we afterwards are often witnessing a push from 61 to 161. You can see the same levels that we have on the downside below 100, 61, 50, 38. We have on the top side 127, 138, 150, 161. And what is the difference between here and here? This is a 100% move. 61.8 to 161, 100%. We see it as well. This is 38 to 138, this is a 100% move. And this is something that is the underlying rhythm of the market. And the reason why the market is following this rhythm is because of the buying and the selling that is going on behind the scenes. There's a specific amount of buyers and sellers that is driving this price up here. And then we have a market phase where the market is going against the trend direction, right? We're moving lower. And the ratio between how far are we going up versus how far are we moving lower, that tells us about the ratio between the buyers and the sellers. If the market would move further down here after the push into the high, it would tell us that there are a lot of sellers compared to if the market, like in this case, is only moving to here, right? We don't have a lot of sellers in this market, and there's probably still a lot of buyers waiting here to get into the next push. And then you can see we have a push here into the upside. So that is what is behind this Fibonacci move. And we can follow this rhythm. We go for the next stage. You can see the next push goes from here to here. Retracement goes to 50. And then in this case, 150. We overshoot it a little bit, go to 161. And then the market rolls over. So nothing in trading is 100% always going to repeat the same way. But that's not even the point in trading. You want to find something that is reliable, that happens very often, and that you can then build an edge around. And if you know what the underlying market rhythm is, if you understand how far trends are going, when they are likely to reverse, that's so important. And it doesn't only work in this macro level, but when we zoom out, what we can see on a big picture scale is that we have this, right? A, B, C. Let's see what this does for us. Let's remove the drawings. Here to here, what we have the retracement to 50 and 150. And let's zoom out. And you can see afterwards, we did have a little bit of a push, but afterwards the trend seems to be over, at least for now, and we rolled over. And you can see how important this information can be for your trading if you understand this market direction and rhythm. If you understand that, if you know that once you have this push here, you have your A to B, then you get ready to see where is this retracement ending, and then you can look for patterns, for example. You could look for here this breakout pattern, break and retest, and if you know that after this push, the market has a high chance of reaching 150, that could be a very, very big game changer for your trading, because then you can trade with a lot of confidence. You know what to expect, you know where to place your target, and you know where to look for signs of exhaustion. And that is just invaluable information as a trader. So I would really recommend to get started with this. Look for those A, B, C moves and then apply your Fibonacci tool. I will show you the settings. So if you put your Fibonacci or activate it in TradingView, you just want to put it on your charts the first time. And then you have this settings symbol. And you can pause the video if you want to have the same settings like me. What is important is that I have it extend to the right. Also, what I do is I set up my Fibonacci levels. Many traders will approach Fibonacci's differently. They use it, maybe they draw it in the opposite way. It doesn't matter because Fibonacci's are percentage based. And that is why I use it that way. I've been using it for more than 12 years. And that's why I'm really comfortable in that way. If you use Fibonacci's in the opposite way, it doesn't matter. It doesn't make a difference. It's percentage based. So no matter how you turn it, it's always going to be the same information. But the point here is that you get comfortable looking for those wave rhythms. We can probably even do it here in the opposite way. Down, up, and then see where this takes us. So let's do that. We go here, down, up. You can see we have here our 38. And then you can see, okay, we have 138. We overshoot it here in this case. And then we turn around. And that, as I said, nothing works 100% in trading, always the same way. But you can see with a high level of certainty, if you know that from 38, you're looking for at least 138, that is something that is so invaluable. And you can see, okay, in this case, we would have made a bigger push. So be it, doesn't matter. Or you want to aim for what is safe, in quotes. Nothing in trading is 100% safe. But if we know that with a high degree of certainty, we can capture this part of the move, that's just information that is so priceless as a trader. And you can even then go to a lower time frame. If you see this A, B, C, you could from that point on go to the lower time frame, maybe from the 1 hour to the 5 minute, then look for patterns around here and then trade it on the 5 minute. And you have many options and possibilities using that concepts. And I think it's a very, very important concept to know, because that's essentially the underlying rhythm of trending behavior. Besides gold, the Australian New Zealand dollar was one of the most fascinating setups for me over the last few weeks. And I want to give you a rundown and a run through of what happened here. So let's remove the drawings and we start on the higher time frame. And what we see here is, let me use the replay tool, which is really, really helpful in TradingView, is that we are clearly in a very long uptrending market. What we can do is we zoom out, and when we zoom out, we can see that the market is in a very tight range here for years and years. You can see we pretty much moved into this zone 2014, and we have been bouncing in this range ever since. And whenever you come to an area of existing or previous historic highs, that is something that a lot of traders will be aware of. You can be sure that a lot of traders are aware of this area here, because it's just historic important level that the market has used in the past. And when you see the market is coming back into it, you can be sure a lot of traders are using this level. Another thing that you can see is that we are clearly in a long trend. So this trend has been going on from November 21, so pretty much 1 year. So what is happening here? For 1 year, people have been making money buying this chart and buying the market up. And what this means is that probably a lot of traders are sitting on a lot of money. And what happens, and you can ask yourself, the more money you have, do you get more greedy? Do you get less greedy? Do you get anxious about your trade? Do you want to exit the trade more or less? You probably are a little bit more anxious to get out of the trade because you don't want to give back a lot of money. And what happens is that a small sign of weakness can then often lead to a cascade of selling. So you don't want to be the last one to exit your trade, right? You don't want to be the last one to run for the door. If you see that people are running to the door, you're going to join them, because the later you are, the more the market is going to go lower already on you, and the fewer or the less you will have in your broker account left, you will give back profits. So that's why in trading we often say that when the market is going to go down, it really accelerates. And you can see it especially on stocks, where the market is in an uptrend, is going down rather slowly and gradual. But then when the market is turning around, you will often have a very steep decline as everybody is running for the door. In Forex, it's less pronounced, but it's still something that is really common. Another thing that we can do is turn on our exhaustion zones to see projections. And what we can see, especially when we drop to a lower time frame, once we turn on exhaustion zones, you can see that during the last month of trading, what we have seen is, or the last week of trading, is that the market was able to push into the zone and didn't immediately fall back. And there was a lot of strength exhibited. After the market pushed in the exhaustion zone, the market was able to hold up there, which is quite a bullish sign. And afterwards, you can see the market pushed even higher. But then this exhaustion zone was reached, and it's a very different picture. We just bounced into the zone and had a strong sell-off. We came back into the zone and an even stronger sell-off. We have this fake out here. So the exhaustion zone tells us that there has been a lot of force here, and the difference between what has happened previously when we dipped in the exhaustion zone, when the market fulfilled its potential, versus this time, it's very different. And that tells us that previously this was very bullish, but this time not very bullish at all. Let's turn off the exhaustion zones and let's look for patterns. And clearly this is a fake out pattern. A fake out pattern is where you have a previous high, the market tries to break above the high, but especially here in the next candle, we reverse lower. We have this pin bar pattern, which is a strong rejection signal. And afterwards, you can see we are not coming close to this high anymore. So the market is now failing to get to this area where we previously pushed into. Another piece to the puzzle on the bearish side. So again, what we want to do is stack as many bearish pieces to the puzzle. What we can do is activate a pivot. A lot of people ask me, where's the pivot point? So I will show you one last time. So let me show you. Go to indicator, then you type in pivot P, and then it's called pivot point standard. Then you have to open it. This is what it shows, and then you open the settings. I turn off everything for the SNR in this example, and we only want to be left with the P. I make it black and a little bit thicker. And what we want to do is, because we are on the 4 hour, we want to change it to weekly. So now we have the pivot point structure. And what we can for now see is that there's no change. We see that each pivot point is higher than the one before, and we have no change in pivot point structure. So we don't have a bearish signal yet. And we have to keep observing and see what we have. We may have, let's get rid of this. What we have is maybe the start of a pattern. We could start using this level here as a potential pattern definer. We have here our swing high, our fake out, and let's see what the market did afterwards. Push into the low, not able, now we get below it, but we don't have the pivot point go. It's very, very important that we need the pivot point go. You can also see how volatile the market is behaving around this area. This is a very, very good sign, because the volatility shows us that there's a lot of buying and selling going on here. And especially at those turning points, if this happens, it's a good sign, because it can often highlight the change in market structure, where we go from more buyers to more sellers. And to do that, we need to make sure that the buyers unwind their position and the sellers get into new positions. And this often happens with this volatility. Very, very erratic movement. Everybody is now running to the door. The ones who want to get out, they see the market is pummeling lower, and they don't want to be left holding the bag at the end. So what happens is that we're staying below this area. And if you've been watching my previous videos, I've been talking a lot about liquidity runs. So what happens is that a lot of breakout traders will probably already be short here. And where do they have their stop loss? Stops on the breakout will probably be somewhere in this area, usually below the last high, which is this one. So that is our stop zone. So roughly around here, we should have our stop zone. We can call it or make it red so it resembles stops. So stop zone here. And what we can see and what we can wait, and I've seen a lot of traders who specialize in stop zone runs now, is that instead of trading the actual breakout, we don't trade the breakout anymore. We wait for the market to get into the stop zone, show us some signs of rejection, and if we move lower, that's where you want to get into a short. So we move away from traditional breakout trading to stop run trading, which can be a little bit more profitable because we get into a higher price. Ask yourself, if you want to be short, do you want to short for 113 or do you want to short for 114? Clearly you want to short for 114. You get way more points here on your side. You get a tighter reward to risk ratio, generally speaking, and therefore a much higher reward to risk ratio. So let's see what happens afterwards. We want to see, can the market get into the stop zone? Also, we want to see the pivot. What happens on the next pivot? We should see a lower pivot. That would give us this bearish confirmation. All right, happens. You can see clearly the pivot point is very, very low now and much lower than the one before. Now we have the pivot point on our side. We have here our stop run. And now what we could do is go to the lower time frame. Now we're on the 4 hour. You could go to the 1 hour, to the 15 minute. You could look for patterns here, maybe trade a pattern like that. And this is how you can then get very tight stops in. And potentially, if the market rolls over, this will not work 100% of the time. But if we roll over, you'll be able to catch a huge winning trade with a small stop loss. You can see that we have break and retests, and the market just keeps on going. And if you're able to specialize in those stop runs, and if you're able to read those signs, when is the market turning lower, and what are the signs that are telling us that we are unwinding, we are going from a buying market to a selling market. And if you're able to read that and anticipate the moves, not predicting the absolute high and the absolute low of a market, that's not what we are after. We want to see clear signs that the market distribution is changing. We're going from buyers exiting the market to sellers getting into the market. We could go even further than later on in other videos or on our courses where we look at trending sequences. How strong are the bearish waves? How strong are the bullish waves? Remember what we did in our previous example, Fibonacci's. So you can see ABC. So we could draw a Fibonacci. What do we have in this case? I have not checked. 38. Where's 138? Here you can see after we push into 138, we have a little bit of a sideways move. We keep on going, but eventually come back to 138 before we move lower once again. And then actually, let's just do it just because I'm interested. I've not done it. So here, ABC, very shallow. So what we have is 61. And the market made it to 138 for now. Let's see, do we get... Okay, and that's where the market is currently at as of today when I'm recording this video. So we are not at 161 yet, but we are getting close. And you can see how we can use all of this knowledge here step by step. We put it together. We gain such a deep understanding of market forces, market rhythm, that we can learn to read the market in a very different way. I hope you enjoyed this video. If you did, leave a thumbs up. Make sure to check the video description for more offers, for more information, and I look forward to hearing from you in the comment section.